Hello everyone. So in this session of Easy with ESOPs, we will be talking about the modes of implementation of the schemes. So there are two modes of implementation, direct and trust route. Direct is where the scheme is implemented directly by the company, and trust route is where the company creates an irrevocable trust for the purpose of implementation and administration of the scheme. So we'll first start with understanding what what is the difference between the trust route and the direct route? What are the merits and demerits of either of the routes? Which companies would prefer either routes? So when we talk about choosing between the two routes, direct and indirect, there are some factors which are very important. First is liquidity. As we know that when we talk about ESOP schemes, it is for the benefit of the employees. So benefit of the employees, employee retention, employee motivation is a very important factor which could only be granted when we say that there's liquidity. If the employees do not have option of liquidity of selling their shares, that would not be solving the purpose of like motivating. That would not be the main intent of the scheme will not be fulfilled. So when we talk about direct route, in the case of here again, there's difference between a listed and an unlisted company. When we say a listed company, the shares are freely tradable, so liquidity is easier to be granted. But when we talk about an unlisted company, there's no exchange where the shares are being traded. So there's a question on liquidity. How is the company granting liquidity? So when an unlisted company goes through a trust route, then where the employees exercises their right on the options, and then to sell the shares, the trust can purchase the shares and the liquidity can be granted to the employees. In case of a listed company also, while the shares are freely tradable, but there may be cases where the shares are not very frequently traded in the market. So there may be a seller, but they may not be a buyer. So in that case also, trust route is beneficial when we talk about a listed company. Second would be dilution. Now, when we talk about a listed company, listed companies would not prefer their shareholding to be diluted. Any XYZ person to to hold shares in the company. So when the scheme is implemented through trust, the trust can like the shares are held with the trust, there would be less dilution. Also, the trust can have the non-economic rights with itself. For example, the voting rights, the scheme can provide that the non-economic rights would vest with the trust even when the employee exercises the shares, the options. Next would be cost. Uh, like there are certain factors like cost, administration, implementation. So administration becomes easier when the scheme is implemented through a trust because there's an independent body that comes into picture. Cost, it's generally not very cost effective. Trust route is not very cost effective as the company grants loan to the trust for carrying out the implementation. When we talk about benefit for employees, so when there is direct route, like there's a mechanism of cashless exercise. For example, when for exercising, so that the employee gets gets the right to exercise the options, they have to pay an exercise price. Now there may be a situation where the employee would not be able to fund the exercise price, would not be able to provide the exercise price. In that case, the company, when the scheme is implemented through trust, the trust can provide for cashless exercise. So cashless exercise is where employee does not have money to pay the exercise price. That what the trust can do is the employee approaches the trust for selling uh, for exercising of the option. What the trust will do is the trust will convert the option into shares, sell the shares in the market. The sale proceeds minus exercise price, all whatever taxes would then be given to the employee. So the employee does not get the shares, but will get the sale proceeds of those shares. When we talk about scheme implemented directly by the company, the giving of loan provision because it's governed by Section 67 of the Companies Act, and according to that, a company cannot grant loan to each and every employee. But granting of loan to employee welfare trust is permitted. So cashless exercise would become easier and would be beneficial in the case of trust route, not very beneficial when we talk about direct route. What is the mode of acquisition? In direct route, there can only be primary acquisition, whereas the company is issuing fresh shares. In case of trust route, there can be both primary as well as secondary acquisition. In case of listed company, secondary acquisition would be purchasing shares from the stock market. But when it's an unlisted company, there's no stock exchange, then secondary market would be purchasing shares from the existing shareholders. Administration, we have talked about that it becomes easier when the same is implemented through trust route. Restrictions on trust would be that trust has to comply with the insider trading regulations. So which route is more beneficial and which route is more prevalent? So if we see this chart, the right side of the chart shows that this is the data of top 50 companies as on March 2023. If we see this data, around 56% of the companies implement the schemes through the trust route. So trust route is generally preferred by large companies where they would want a separate body to implement and administer the scheme. Now we'll be talking about both these routes, like how these two routes work. So when we talk about direct route, let's take two instances where the employer is unlisted, where the employer is listed. So where the employer is unlisted, the company would issue shares to the employees, and where the employer is listed, same procedure would be there. However, in principle approval as per regulation 28 of the listing regulations will have to be obtained by a listed company when its new shares comes into existence. In this process, there would be increase in paid up capital of the company because the company is issuing new shares to the employees and there's no secondary market acquisition. Talking about indirect route, so this is a 6-step procedure. Step 1 is formation of a trust. The company forms an irrevocable trust. Second is granting loan to the trust. Third is company grants shares to the trust, or the trust acquires shares from the market, as the case may be. Step 4, company grants options to the employees. Step 5, employees exercises the options. Step 6, trust repays the loan to the company. So this is a very brief procedure. Now let us understand why does the company grant loan to the trust? At what point of time does it grant? When would the trust acquire shares from the market or from the company? So these are certain questions which we'll be discussing. Why is loan required to be given to a trust? As we discussed, that trust is an extension of the company itself. Company has formed the trust. The trust does not have any fund of its own, does not have any assets or liabilities. So the company will provide loan to the trust, and the same is permitted under Section 67 of Companies Act 2013. Now, when is the loan, like once the loan is given to the trust, then the trust would acquire shares from the market or from the company. So what is the point of time? To understand this, let's first see what does the guidance note on, what does the accounting standards say? So there's a guidance note on share-based employee benefits by ICAI. So that recognizes three stages, like three events. First is where company allots shares to the trust as and when the employees exercise. In case of second and third, there's involvement of loan. So the company gives loan to the trust at the beginning, trust purchases from the company, or the company gives loan to the trust at the beginning and trust purchases from the market. So when we talk about case number 1, there are two things. There's no involvement of any loan. There's no involvement of any loan, and there's primary acquisition. It does not talk about secondary acquisition. The company allots shares. So the case 1 would be relevant only in case of an unlisted company, because when we talk about a listed company, it says that when the trust has acquired shares from the secondary market, it has to hold those shares for a minimum period of 6 months. So there's a minimum holding period on the trust for 6 months. So going for this case where there's no loan provided by the company to the trust, because the trust is the exercise price which the employee is giving to the trust is itself funding the purchase of shares. So there's no involvement of any trust. And this would not be suitable in case of a listed company, because there's a minimum holding period of 6 months for shares that are acquired through secondary market. Second and third involves now also in case number 1, when we say that the restriction under SBEB is only with respect to shares that are acquired from secondary market, and not primary market is not mentioned there. Now, one reason for that could be, say for example, the market price of company share is 100 rupees, and the company is issuing ESOP to its employees at 50 rupees. So when I say that the trust would acquire from the trust would acquire from the market, in that case the price is 100 rupees and the employee is paying 50 rupees. For the employee, the exercise price is 50 rupees, but the trust will have to if the trust is purchasing from the market, it will have to purchase it at 100 rupees only. So that 50 rupees would not be sufficient to fund that exercise price. Second and third case involves giving loan to the trust at the beginning, where the trust then purchases from the company or from the market. Now, when we say that loan is given to the trust and the trust purchases, what point of time would the trust purchase from the company or from the market? So, as I say that in where the shares are to be acquired through secondary market, the trust has to hold those shares for a minimum period of 6 months. So, to take an example, if the exercise period of the company provides an exercise period of 6 months. So once the vesting period gets over, the employee has 6 months of time period to exercise. So the employee may exercise within 2 months, within 3 months. So in that case, the trust will have to acquire the shares from the market prior to the completion of vesting period, so that that minimum 6 months holding period is complied with. Coming back to the questions, so can the trust do external borrowing? As we discussed that the company gets loan to the trust, can the trust acquire money or like funding from banks or financial institutions? The answer is yes, but the same would be expensive, because when the company is granting loan to the trust, Section 186 does not get attracted, which means that the company can give interest-free loan to the trust. But when the trust is acquiring borrowing the same from banks or FIs, then interest would get attracted, so it would become expensive. At what point is acquisition done by the trust? So we discussed that there's a minimum holding period of 6 months in case of shares acquired through secondary market. So it would be grant or vesting period, depending upon what is the exercise period that a company provides. Can the mode of implementation be changed? For example, the company is implementing the scheme through direct route. Can it go for trust route? Yes, the same is possible, subject to approval of shareholders by special resolution. Who can be a trustee? So, in case of a trust, there's a negative list which is provided under the SBB regulations, that these people cannot be trustee, which includes promoters, those holding 10% of beneficial ownership. Shareholding of the trust is shown as non-promoter, non-public. So this does not count for the minimum public shareholding of 25%, because this is non-promoter and non-public. How many shares should be acquired? So there's a limit in case of secondary acquisition. When the trust is acquiring shares from the secondary market, there's restriction on the number of shares that it can acquire that it can hold at a point of hold at the end of a financial year, and that it can hold at a certain point of time. So the secondary acquisition shall not exceed 2% of paid up equity capital of the company as at the end of previous financial year, and at any point of time it shall not exceed 5% of the paid up equity capital of the company. So what which means that if they should not be unappropriated inventory. Unappropriated inventory is stocks, options which are not backed by grants. The shares, the trust has purchased shares from the market, but those are not backed by the grants. Against that, company has not granted any options. So that unappropriated inventory, the trust has to, there are certain procedure which is mentioned under the SAB regulations, which the trust has to take care of, so that it does not hold unappropriated shares uh, up up to a certain point of time. So here we in this session we discussed about the two modes of implementation and certain questions related to that. In the next, we'll be continuing with with the modes of implementation with further questions on it and the accounting treatment in case of direct and indirect route. Hope you found this video helpful. Thank you very much.